Welcome, everyone. We're in the last stretch. And this is the last plenary session of this regional conference, the 10th one, Crecer 2019 on auditing and accounting. The main topic here will be the use of information for decision making and risk management, social risk management. This session will be moderated by Xiomara Moreno, Manager of the Practice of Good Governance for Latin America and the Caribbean. And let's receive Xiomara with a hand that has been in charge of the organization of this conference. Let me present the panelists, and we have Vanessa Gibson, and she's the manager of investment climate for CINDE. She's worked for these institutions for 20 years. She started working as an economic researcher. 3 years later, she assumed the position of the service sector. In 2009, she was in charge of aftercare. Before being in CINDE, she worked at the Central Bank of Costa Rica. She's currently the investment climate manager. She has the responsibility of developing the relationship with companies that are set up in Costa Rica and to generate the right investment conditions and investment for foreign direct investment. Vanessa Gibson has a degree in economics, and she has a master's degree in project management and development, both degrees from the University of Costa Rica. Thank you, Vanessa. We also have with us Fergus McCormick. He's the director of Sovereign Research and Value Markets Alliance. He's él fue economista en IBRS en América Latina, un economista en Morgan Stanley, un capital en Bernsteins y economista en el Banco Interamericano de Desarrollo. Tiene un título de la Escuela Paul de Estudios Avanzados en Johns Hopkins. ¿Y de dónde es usted? Princeton. Gracias. Tenemos a Alex. Head of the International Monetary in the financial sector, stress tests, and allocation as representative of the IMF in the north of Macedonia. Before being in the IMF, he was a professor of microeconomics at the University of Rijeka and Timbergem Institute in Amsterdam, and a researcher in the Central Bank of the Netherlands. He has a PhD in microeconomics by the Vrije University and the Tilburg Institute. And where were you born? Cerca. Queso para nosotros. Stanford. He's a technical director of the Council of International Standards in the Public Sector, IPSASB. He has experience in accounting standards and accounting analysis with the Institute of Public Accounting of the UK. He also has experience in financial audit and performance in the Auditing Commission of the UK and the Auditing Office of New South Wales in Australia. He started working as an employee of this organization in April 2005 and was a technical director based in Toronto, where he lives since 2016. He was a member of the Advisory Council of the International Standard Body of Financial Information between January 2016 and December 2018. And in a previous intervention, he told me he was born in the UK and lives in Canada. So our moderator, Xiomara, has the floor. Thank you, Glenda, and thank you all for your attention. It's an honor and pleasure for me to have such a diverse panel as I have today. As Glenda has said, I not only have the presence of the IMF and XSB in this case, but also the presence in the case of investors, the Fergus, as well as Vanessa. So in this regard, I feel that we're doing a connection between the public and the private very well, and mostly between the multilateral organizations, in this case, the World Bank and the IMF. The panel we're going to have has a slightly different format from what we've seen yesterday and today. This panel has been specifically designed for the closing ceremony activity because we've been discussing since yesterday how financial information, how transparency are ingredients to attract FDI and to have the interest of investors, not only in the region, but also to invest in our countries for the achievement of the development goals. In this sense, this panel will consist basically of two main parties. The first one is a presentation that will be given by Alexander from the IMF, and it'll take approximately 20 minutes. Then we're going to have a discussion with the panel from the various perspectives through questions that I will be asking to each one of them. Some of these questions will be applicable to all, and others specific to the area or the approach they represent on this panel. Finally, we're going to have some 15 minutes so that you as an audience can share any question, whether at a technical level or as citizens and professionals that are here today in this conference. So the panel, again, we hope we have your attentive presence. We're going to drink wine afterwards. We're going to celebrate the success of growing. And before going to the cocktail, we're going to have Oscar Avalle that's going to wrap up the conference officially. But because we've had 2 days of discussions around how to attract private investment, how to do good public management and use the information that we as accountants prepare and supervise as auditors, in one way or another make the decisions when we're in government positions, we see that at this moment, this, which is a commodity, it's the raw material to attract not only the investors because of their trust in our governments, but also to make decisions and have better management of public finance. And this will lead us to conclude part of the topics we've been discussing these 2 days. With no further ado, and before giving Alexander the floor, I just wanted to mention 2 fundamental issues in the discussion this afternoon. Alexander will present what the IMF that is aligned with the XSB, IDB, World Bank, IFA, and others, has recognized that the use of the general balance of public accounts in governments is, if you will, the most appropriate tool that in the long term can help our governments to have better management of resources because of the way fiscal management is done, and not only be making decisions at a government level based on the debt or the deficit. In the same manner, the private sector can generate more trust because they not only see the solvency of the credit soundness of the government and the resilience to strong winds that may arrive with another financial crisis. With no further ado, the second message that I wanted to transmit, that as accountants and auditors that we're all here, accounting has been existing in two ways for centuries. The private sector developed double priority accounting in international standards for financial information. In the public sector, we've been adopting the standards in such a way that governments can get closer to the market accounting and reflect in our public account what our government has and what it owes to get to the public capital. But this is something that hasn't been possible for several years because of different reasons that our panelists will also deal with. So please, your attention in this last hour. Keep yourselves on your toes, ask as many questions as you have. Any observation, any question, any concern you have will be very well received. And that's why CRECER has become a flagship initiative, so that we can all speak the same language and have the trust of expressing what we need to say. So let's give Alex a big hand and he'll begin his presentation.
Introduction, Xiomara. Today I will talk about an IMF flagship publication from last October. I have one copy here. Whoever wants it is welcome to take it. Of course, it's published, so it's on our website. What I will do is, I understand, I wasn't here yesterday, but I understand you've been talking a lot about the importance of transparency, accountability, and how can you improve that by improving measurement, improving accounting standards. I'm going to take a slightly different perspective. I'm going to focus a little bit more on why we do it outside of transparency and accountability. So these are extremely important goals in themselves, but I'm going to present a little bit more from the macroeconomic angle, some other reasons why it is very important to look at the entire wealth of a nation. Now, what do I mean by that? By the wealth of the government of a country, I mean the public sector balance sheet. I'll explain in a moment a little bit more what it means, but basically it's not just what we normally think of as government, but it is also all the other entities that government controls. So public corporations, or if you will, state-owned enterprises. These are all ultimately owned and under control of the government, so they ultimately contribute to government resources, to assets, and they also contribute to risks. I mean, often you see when things go wrong that risks pop up somewhere in the state-owned enterprise sector, and then in the end the government has to help out, has to bail out, or has to do something else. So it's not just an asset, but it's also a risk. So we take this broadest possible coverage of the public sector as the ultimate broadest coverage that you can, broadest fiscal picture that you can take. I have a few slides to show you why does this matter from a macroeconomic perspective, as I just said, and then I'll go into some specific country examples that we also discuss in the fiscal monitor, to just show you how this can be used in the context of specific country cases. Finally, I'll conclude. So, what is the public sector balance sheet? As I just said, it has this broader coverage. It brings in all the state-owned enterprises, and then you cannot just add this up, but you also have to consolidate all the cross-holdings. So loans from governments to state-owned enterprises have to be taken out, otherwise you're double counting. At the moment, you have major central banks holding a lot of government paper. These kind of things you have to consolidate away. So you really have to have a consolidated balance sheet of the entire public sector. That allows you to move beyond the more narrow fiscal metrics of debt and deficits. And these are the things that we normally look at. So it doesn't mean that these are not important. I think these are very important, but you have a complementary, broader view of the fiscal picture. Importantly, this sheds light on public sector assets as well as liabilities. Now, in many countries, governments don't even really have a good tally of what assets do they have on their balance sheet. Now, if you don't know what assets you have, you cannot really start to manage them better. I'll show here that better asset management actually can yield substantial revenue. And that's an attractive proposition for a government, right? If I can get more revenue from my assets, maybe I don't have to increase taxes in order to fill some gaps. The liability side is also important. So on the liability sides, we go beyond debt that we normally look at. And you will see, or I'll show you that there are very important liabilities that are almost like debt, but that are often ignored in standard analysis. I'll show you the macroeconomic relevance of all of this, and show you a few applications of this conceptual framework to improve, how can you use this framework to improve fiscal policy, or how to improve fiscal risk management. Now first, what does the public sector balance sheet actually look like? Now in this publication, in the Fiscal Monitor, we developed the public sector balance sheet for 31 countries across the world. I'll show you the 31 countries in a moment. These 31 countries together represent over 60% of global GDP. So we have a big chunk of world GDP covered here. Now if I aggregate the balance sheet of these countries, I get the picture that you see here. First thing to notice here is that the asset side is really, really large. This is more than 100 trillion US dollars, or well over 200% of GDP. So these are really large assets. What do they consist of? Well, financial assets. This is money in the bank, for instance. This is something that actually governments do look at. Other things, what do they look at less? Well, things like infrastructure, your roads, your schools, your hospitals. They're very important for economic growth. They're very important assets. It's not necessarily that you have to maximize the money that you get from these assets. I think that's not the idea here. The idea is just that you know what you have and that you can see if there is opportunities here to manage these better. Next big asset, natural resources. Here you see that on average, this is less than 40% of GDP. This is very, very skewed. There are many countries that have very little natural resources, and there are a number of countries that have vast natural resources, a number of them actually here in Latin America. And I'll show you that picture in a moment. Now on the liability side, I mentioned that this goes way beyond general government debt. You see here that general government debt, the standard fiscal metric, is only about half of the total liability side. Another very important element here are pension liabilities. And these are pension liabilities to public sector employees accrued today. So this is not things like Social Security, which is a future social expenditure. This is really much like debt. You know, it's enforceable in the courts in most countries. However, it's not recorded as debt. Now here's the picture that I mentioned, the picture across countries. So these are the 31 countries that we cover in the Fiscal Monitor. A few things to note here. If you look at assets minus liabilities, you get a country's net worth. About 2/3 of the countries here have positive net worth. This is the black bars that you see. About 1/3 of them have negative net worth. Now a country is not like a corporation. You can run a country perfectly well with negative net worth. It does mean that eventually you'll probably have to make some kind of adjustments, but you can go on like this for many years. So it's not net worth as such. It's not the goal of government to maximize net worth. This is, it's the goal of government to provide services. But still, it's an indicator that you might want to pay attention to. You will also see here, I've also put in these yellow diamonds. That's actually general government debt. So you see that if you look at net worth, it presents a very different picture than if you just look at general government debt. Something else to note here is that the countries with the highest net worth are actually the natural resource producers. So you see here countries like Norway, Russia, Kazakhstan, Australia, Peru. These are countries with vast natural resources, and some of them have sold some of these natural resources and actually put them into a sovereign wealth fund. Like in Norway, half of this value is actually the sovereign wealth fund. The other half is oil and gas still in the ground. But that's one thing to note. Another thing to note is that actually most of the G7 countries have negative net worth. We have 6 of the 7 G7s in here, and I think all of those have negative net worth actually. Now, what about the countries in Latin America that we have in here? We have 5 in this exercise: El Salvador, Brazil, Guatemala, Colombia, and Peru. And if I just consolidate, or not consolidate, if I just add up the balance sheet of these 5 countries, it looks like this. You will see that, first of all, natural resources play a much larger role in these Latin American countries than overall. You see here already 60% of GDP in natural resources. You also see that the pension liabilities are actually a bit lower. Now this has to do, I think, with 2 things. First, while aging, these countries are still somewhat younger than most European countries. It also has to do with a relatively low coverage. Many Latin American countries have pretty elaborate pension schemes that actually only apply to a very small part of the population. So that means that, it might not be fair for the people, but at least your liability is not as high. So these are just some of the observations focusing on Latin America. Okay, here are some of the actually categories in the balance sheet in a little bit more detail. On the left-hand side, you see non-financial assets. So these are actually, this is your infrastructure. You see that this is pretty substantial across the world. On the right-hand side, you see the natural resources. And this is what I said before, very skewed picture, with Russia well over 300% of GDP, Kazakhstan over 200% of GDP, but also quite a few countries that have 0 or virtually 0. So this is very important for very specific countries. On the liability side, one more asset. These are actually the assets of the public corporations. So you will see here that taking these state-owned enterprises, taking these public corporations and adding them in is actually very substantial in many countries. The assets of the public corporations range from roughly 50% of GDP to 250% of GDP. So this is a big important chunk of assets. On the right-hand side, you see the pension liabilities that I mentioned, also very skewed. But these are, once again, these are the year-to-date accrued pension liabilities of public servants. So if you take, in addition, things like Social Security, well, that works different from an accounting perspective. That is basically coming in through future expenditure. So that would come in if you take the net present value of what happens in the future. Those things come in as well. But that actually worsens the picture in many countries. So these accrued pension liabilities year to date are already very large in many countries. Now, just to present a few caveats, I mean, balance sheets aren't easy to put together. There's a lot of measurement and data availability issues. And I think this conference here has actually geared towards these measurement issues. So how can we improve accounting standards in order to get better measurement, to get better cross-country data to actually work with these things. Now, another caveat, many assets, and think of infrastructure here, they're illiquid. They're not easy to monetize. I mean, you can do a little bit, you can transfer a road into a toll road maybe, but you don't want to start selling off your schools or your hospitals. So these assets are there. They're important for you. They're not easy to monetize. So you have to kind of keep that in mind. If you are hit by a crisis event, if you have financial assets, you can probably use those fairly quickly to plug the hole. Non-financial assets, not so much. Also, I think historically we see that assets are generally more volatile than debt, so that's also something to take into account. But for these reasons, first of all, I would say that the balance sheet approach, it complements the existing approach based on debts and deficits. It doesn't supplant it. For reasons of liquidity, I mean, don't just look at net worth, but also look at things like net financial worth, which excludes non-financial assets. Look at liquid assets versus liquid liability to see what kind of liquidity issues you might be facing. And of course, getting to the measurement and getting to what you all are doing, strengthen the statistical and accounting systems to actually bring this data out better. But I think very importantly, our publication, our fiscal monitor, shows that it is actually, even with what we currently have in terms of publicly available data, it is feasible to compile and analyze estimates of public sector balance sheets, of the whole public sector, across all income levels. We have many advanced economies in our sample, but also quite a few emerging markets, plus a few low-income countries. Now let me turn to what I promised before. So why is this important, outside of the accountability transparency? First of all, remember that we had these very large assets, over 200% of GDP. These assets actually present quite a large revenue potential. Now, I'm not talking here about selling off your schools and your fire stations. I'm not talking about privatization. I'm not talking about who owns the asset. But I am saying that a lot of these assets actually yield abysmal returns. If I look here at the public corporations, now public corporations are corporations that are actually operating at a market basis. If they were not, they would already be in general government. So these are the guys that are supposed to work on a market basis. In our sample, this is the distribution of returns. In our sample, the median return is 0.6% return on assets. Now that is very, very mediocre. Now we do on the right-hand side, we do a little bit of a back-of-the-envelope calculation. We say like, well, what about we bring the not so good performing public corporations up to the 75th percentile of our sample? So, you know, you don't have to be the best student in the class, but you just have to be an above average student. So if you can bring these public corporations to be these above average students, how much revenue would that get me? Well, that comes to about 1% of GDP each year. We do a similar exercise for government financial assets. And financial assets, remember, were quite large. We're almost 100% of GDP. We do that in a risk-adjusted way. So how much extra revenue could you get from better managing government financial assets without correcting for risk? So if you just get a better return by running a very risky portfolio, that's not what this is. But there you see that you could get up to an additional 2% of GDP in revenue. So this is a total of 3% of GDP in revenue. Now 3% of GDP in revenue, that's on average what advanced economies take each year in corporate income tax. So these are important, large revenue gains. And this is a very interesting way of looking at things, because if you say like, hey, I can get more revenue from my assets by better managing my assets, maybe I don't have to increase taxes in order to plug a fiscal hole that I have. Or maybe I can lower taxes, maybe I can increase social assistance without jeopardizing my fiscal sustainability. Here's another reason why balance sheets matter. Here I show you actually the results of 3 different regressions of long-term government bond yields on the left-hand side, explained by gross debt and a number of control variables. Now the first regression, the first thing you see is like, okay, if I have higher debt on average, I pay a somewhat higher interest rate on my debt. This is well known. The second regression, they actually say, well, but if I have also assets, if I have a lot of assets, these assets also matter. Countries with lots of assets actually pay a slightly lower interest rate on their debt. So this is actually interesting. When we started this exercise, I thought like financial markets don't pay any attention to these assets that government have because they really don't know the numbers. And this is not easily compiled. However, implicitly, these regressions seem to suggest that they do pay some attention to it because countries with larger assets tend to pay a little bit lower interest rate. And here's the slide that I actually like the most in terms of macro relevance. What does this show? This shows that countries with stronger balance sheets, which is the blue line, when they're hit by a shock, on average they face shallower and shorter recessions than countries with weaker balance sheets. And this is already, this is in effect over and above debt, or in econometric terms, the debt stock is already in our control variable. So this is purely a balance sheet effect. Now why is this? This is basically because countries that have stronger balance sheets, when they're hit by a shock, they can use their fiscal policy tools. They can actually increase spending much easier than countries that are already in a bind. So these are some big-time macroeconomic reasons why this kind of thing is important. I have a couple of country examples. This is I'll go through just a few of them. Here we see actually what happened to net worth, net financial worth since the financial crisis. So we see that net worth has decreased a lot. But what's behind that? On the other side, you see the assets and the liabilities. And we all know that liabilities have increased a lot. Government debt has gone up a lot over since the crisis. But we also see here that the assets have increased quite a bit. Now what's that? Mainly, and I'll show you this for the UK, mainly this is basically taking over some of the really big banks. So here you see the balance sheet of the United Kingdom, the public sector balance sheet. See, it was that assets, liabilities stood at about 100% of GDP until the crisis. Then they had to intervene in the major banks. So these banks actually became public entities, and of course that blows up the balance sheet on both sides, right? So both assets and liabilities. The capital injection that they actually had to do because these banks have capital shortfalls, that is just the difference between these assets and liabilities. But you see this balance sheet really increased by a lot, and then they've wound it down bit by bit over the years. But these are the kind of balance sheet effects that you see in the crisis. Second example, this is about risk management. So this is the US. Here we do what we call a fiscal stress test. So what do? We basically take the kind of scenario that the Federal Reserve uses to stress test the big banks in the US. Now what kind of a scenario is that? It's pretty much a repeat of the global financial crisis without the big fiscal stimulus that the US did. So now we say, like, okay, we take that scenario. We don't want to argue about the scenario that we take, so we take their scenario, then we apply it to the public finances. And what do we see? Now this is what you see on the right-hand side. You see, of course, a big impact, but where is the impact? Well, the first red bar is debt. You see an increase in debt. This is your automatic stabilizers. You get less tax revenue and higher social expenditure in a crisis. Fine, we know that. The second red bar is your non-financial assets. The government owns a lot of real estate. This real estate plummets in value in a crisis. That's a big hit. The third bar is actually also interesting. It's very, very small. Now this was, in the US they call it the government-sponsored enterprises. So these are the companies that were actually securitizing mortgages. They were a major source of fiscal risk during the crisis, and the Treasury had to step in and fill the hole. So this was a major outlay for the Treasury. Now here we see actually that if we repeat a scenario like that, you would not see a super big hit there. These guys have cleaned up their balance sheet. Their balance sheets are shorter, but what they have offloaded is also the most risky stuff. So I found that an interesting conclusion in itself. The next bar I found maybe the most interesting. Pension liabilities. So if you have another crisis, you see a big hole opening up in pension liabilities. Now where is this in the US? It's not at the federal level. The federal level is defined contribution pension system, so this is individual savings accounts. The risk is on the individual. This is at the state and local level, where there's still a lot of what we call defined benefit pensions. So you have promised people a certain pension payment when they retire. Now, they already have big shortfalls. In the Fiscal Monitor, we show that even now, out of the 50 US states plus the District of Columbia, so out of these 51, 49 have a shortage. And this is using US accounting rules that are very, very generous towards equity holdings. Now, if you get a crisis on top of that, you can think about what would happen to these equity holdings. This gap would be a lot larger. I think actually this is something, we've seen in the US, we've seen a couple of examples. We've seen Detroit going bankrupt on pensions and other obligations. We know that Illinois, where Chicago is in a huge hole. But I think there's many more that are actually not doing very well, and I think this is something that we will see happening over the next 10, 20 years. But it is not something, again, that you see popping up in the standard fiscal analysis. I mean, people that have looked at US pensions, this is not a surprise to them. People that just look at the general fiscal accounts, they might not pay that much attention to it. Let me see, I think I'm out of time. I will stop. I will not do this the last example on the intertemporal balance sheet. I will just conclude. In conclusion, our report, I think, shows the macroeconomic benefits of public sector balance sheet analysis. It shows what you can do with these improved accounting standards that you all are working on. If you get better measures of public sector wealth, of public sector assets and liabilities, why does it matter? It helps you identify and manage risks. It can help you in evaluating fiscal policy, and it helps you with your macroeconomic resilience. What are the next steps? Well, countries start compiling balance sheets. I think we can talk about this a little bit more in the panel as well. But we see several examples of IMF country teams, but also countries themselves actually picking up this theme and saying like, look, we understand this is important, let's do a little bit more over it. So, and over time, I think also the improved statistical and accounting standards will contribute and will allow even more of this. So let me stop here and we can start with the panel. Thank you.
Thank you, Alex. Thank you very much for sticking to the time. I'm going to turn now into English because to moderate the questions, I'd rather do that because all the speakers speak English. But at any time, I'm also going to be probably switching back and forth to Spanish. So as you all saw in the presentation, and Alex stressed, transparency and accountability, which is actually why we've been underlined that to close the Crecer with this presentation and this discussion is something really like a gospel, I would say. So if the IMF say it, then we go for that, we go into the wagon. So we have another ally now for us as accountants, for us as auditors, for us as regulators to actually talk to our finance ministers, to our constituents, and then continue, you know, pushing for adapting or adopting international public sector accounting standard, or at least accrual accounting on a phased approach for those that haven't started. Having said that, also in the presentation, we saw how Alex stressed in the analysis that the IMF did, the importance of the infrastructure assets. We've been talking about infrastructure since yesterday to sort of like attract the private sector investment and mobilize financing for development and achieve the sustainable development goal. So all in all, we are actually talking the same language, the same gospel in different words, right? So what I would like to do right now is turning to my other panelists and give them the opportunity from their perspective to answer some of the questions that we have. Some of those questions may not have an answer or a unique answer, but at least we get their perspective, their opinion based on their own experience as practitioners or even as investigators. So I'm going to start with a general question for the four of them, including Alex, and this actually relates pretty much to what we were saying about accrual accounting. And the general question is, to start with, John to my right, and then continue in the same order. How can accrual-based information actually improve and exercise, I would say, the benefit of having the accrual accounting for decision-making at our government level and then do the fiscal risk management? Again, is how can the accrual-based information that we all propose, promoting the adoption of accrual accounting, can actually influence us to go in this road or get the balance sheet approach as the time comes. Back to you, John.
Muchas gracias. Me disculpo hablar en inglés. Thanks to Alexander for the terrific presentation. Well, I think accrual-based balance sheet approaches, as Alexander's presentation has indicated, they are so powerful because they present the resources of government and the claims against those resources. And that allows a fuller embrace of public wealth and a focus on net worth as a key metric. Now, I think that we need to emphasize here that net worth will not be a metric which will be reviewed in isolation. It's a metric that is complementary to the more traditional measures of gross and net debt. Nevertheless, it's very, very powerful. I think another feature to emphasize in the context of accrual information is that the information presented has got to be comprehensive. There's two dimensions to that. By comprehensive, we mean that it needs to include a large number of entities under the control of government. And Alexander's presentation, I think, has emphasized the importance of this in the context of some of the examples they used. So, for example, Kazakhstan, also Gambia and Indonesia, they're all jurisdictions where the performance of state-owned enterprises is very, very important and significant for an overall analysis of public wealth. If you don't include those state-owned enterprises, you get a very different picture. The other dimension to comprehensiveness is that all assets and liabilities need to be included. Now, at the moment, some of the information, as Alexander indicated, is missing. Some of it needs to be increased in quality. A big issue in this part of the world, or for many jurisdictions in Latin America, natural resources. And we saw that overall, they are far more significant in Latin America than they are in other parts of the world, for instance, Europe. I think there's certainly scope here for linkage between statistical accountants and accrual-based entity accountants to improve definitions of natural resources, to firm up on measurement approaches. So that's an area where I think we can work together in the future. And as I said earlier today in another context, if you look at natural resources in different parts of the world, you get different perspectives. So in Latin America, you're likely very much to get a focus on subsoil assets. Go to Australia, the focus there, for understandable reasons, is on water. Go to parts of southern Africa, then there's a suggestion that you should also be bringing flora and fauna into the analysis. So there is work, cooperative work, that needs to be done there. And I think also there can be an improvement of some of the data in area like pensions, not just employee pensions, but also social security pensions. So there's scope for further refinement, further consistency in that area. And we've also in this conference talked a lot about public-private partnerships in the context of infrastructure, how many jurisdictions are seeking to narrow that infrastructure gap by relying on public-private partnerships. Yes, it's essential that those assets are shown on balance sheet, but also the liabilities associated with them are brought on balance sheet. Now, for politicians, that's not always the most popular thing to do. But another lesson of the analysis of the Fiscal Monitor is that entities which are more transparent are in a better position to actually address fiscal risks when those fiscal risks materialize. So whilst it's a difficult sell for politicians bringing liabilities on balance sheet, there are real benefits to it. Okay. Thank you.
Okay, I'll be very brief in my answer because I took already 20 minutes of your time. So in terms of fiscal risk management, I showed the example of fiscal stress tests for the US. I think more countries can do this. We've done it for a few other countries. And you can sometimes see risks emerging from areas where you wouldn't really a priori expect that. So this can be really kind of interesting. Then, you know, after that, you can start to ask, now that I'm aware of these risks, do I want to mitigate them? And if so, how do I do that? Or maybe I'm okay with them. You know, in the case of Kazakhstan, for instance, they had a major hit, but they also have a big sovereign wealth fund, and you know, they basically threw 10% of GDP at the problem, and they could do it, and they were perfectly okay after that. So they might say, like, okay, this is a risk that we can run. In terms of policy making, we have a few other examples in the Fiscal Monitor. One that John mentioned is Indonesia, where we looked at, okay, Indonesia has a relatively low revenue. They have tax revenue of about 11% of GDP. Now, that's pretty low. They have a program to increase that, and with that money, do a lot of public infrastructure expenditure. Now, you know, infrastructure, if you've been to Jakarta lately, you can see that they actually need this. This is really a fairly disastrous state. Now, we use this balance sheet approach to say, like, okay, what happens? You know, you build up an asset, but in turn, if you believe that there's big infrastructure bottlenecks, building up this infrastructure asset will actually allow for higher economic growth. So you get a positive feedback cycle, and higher economic growth will actually increase your tax revenues. So you can see this whole picture happening using a balance sheet approach. Let me stop there.
Thank you. Let's turn back now to Vanessa to make a gender balance.
Yeah, don't worry. Thank you very much. From a private perspective, I think it's very interesting. We have to add that it's not just about the consistency of the information and how countries are able to project their welfare in terms of wealth, but as well in the time in which we are right now, in order to us attracting companies, for example, in our case in Costa Rica, to promote the country and attract companies to establish here and create all the synergy of growth and creating jobs and welfare. The sanity of our government is critical. Companies are seeking today partnerships. They want to join efforts in terms of building value. So if the government doesn't have a clear understanding as well of their resources and where they're generating value as well, we lack in terms of the opportunity of facing the challenge of this fourth industrial revolution, for example. There are so many issues today that are challenging companies to understand, well, what's their next value proposition, and they need a strong partner, and much of that strong partner comes from the government itself. But we need to understand as well as governments where our strengths relies, what resources we have, and really take a good lecture of our society and where it's going. In terms of building up the right assets for future, for example, this is something that we find as a potential to continue attracting investment, but the first step is for us as a country to have that figured out. And in that regard, I think from a country perspective, public-private partnerships looking forward for development requires, what was already said here, very strong, a very strong financial background in terms of the country. But I think it's a time as well to rethink if we as a country and countries are really adapting all the norms and the standards to what's the reality of our world today and how fast technology is changing the way the other side of the street is working, meaning the companies, the society, and others. So my question is always, how much of what's happening in the accounting departments of governments are really looking through the window to realize how much change is happening and how even the way we run our accounting and how we measure value in the different industries has changed and is continuing to change. So how much of that will actually restrict the potential of growth and building our wealth?
Thank you. That's an excellent approach. Fergus, give us your investors' perspective from the market.
Bueno, en español.
É uma honra estar aqui. Bom,
Voy a cambiar al inglés.
Investors hate one thing more than anything else in the world, and that's uncertainty. So if they are buying the bonds of a particular country, in other words, lending money to that particular country, and there's information that that country has that is not being disclosed, that breeds suspicion. It gives investors the idea that a country has something to hide, and as a result, investors will demand a higher premium on the bonds. And of course, during a stress scenario, what will happen? The bond spreads will increase even wider, making it more difficult for a country from a fiscal standpoint and also from a monetary standpoint to meet its debt payments. So I think that's a very, very powerful argument for a country to disclose as much on its balance sheet as it possibly can, both assets and liabilities. Second, biggest point of the day, Alexander has made it, is that stronger balance sheets, in other words, more transparent balance sheets, result in recessions that are shallower and shorter than countries with weaker balance sheets. I think those 2 points, having to pay higher interest rates, having shallower recessions, having more resilience as an economy, are 2 very, very powerful arguments for a country to disclose as much as possible. The second thing I wanted to mention just in these introductory comments was that for a finance minister or a debt manager to concentrate only on the flow side of revenues and expenditures in the central government or the federal government, and for a debt manager only to focus on debt to GDP and debt servicing capacity and the cash needed to pay down that debt, is that they're only concentrating on 1/4 of the pie. The communication to a rating agency or to an investor improves dramatically if you include and talk in your discussion about the other 3/4. In other words, in the case of Brazil, yes, there's a social security deficit. The social security reform needs to pass. The deficit is as high as 7 to 8% of GDP. Gross debt to GDP is over 80%. Yes, it needs to turn around, but what about the assets in the state-owned enterprises? No one talks about those. So right away there, if you can prove you have assets in the state-owned enterprises, that changes the discussion. Something well worth thinking about.
Thank you, Fergus. Now that we talk about in general with our panelists, or the focus on the balance sheet approach, I wanted to turn back to John. John actually was talking about natural resources and some of the state-owned enterprises that the government control, etc., which is in some respect is the asset management side. I wanted to turn out into the liability side, John, and I really would like to hear your opinion about some liabilities might still be missing in the definition of the government debt. Could you actually tell us further what will be the impact of having a broader definition of debt in terms of fiscal risk analysis?
Well, I think the implication is that you're going to take stock of a broader set of obligations. I've mentioned some of those already: social security obligations, obligations arising from private-public partnerships. You can also mention finance leases. Alexander's mentioned public sector pension employee obligations, which clearly are very large and difficult to control in some parts of the world. Alexander's used the example of the local government and state level in the US, but also, I can think of parts of Europe where this is quite an acute problem. The other thing is that it's important that the debt of state-owned enterprises is taken into account, and further, that guarantees from the general government sector to state-owned enterprises, are fully acknowledged, and also the contingent liabilities that may arise. So if, for example, you have large-scale financial guarantees which are guaranteed by the general government sector, then any analysis that doesn't take those into account, I think, is deficient, and that certainly needs to be looked at. So I think there is a need to challenge what I think has been called in the past the traditional definitions of debt, which are of themselves incomplete. Okay. Thanks, Xiomara.
Thank you, John. Let me turn now back to Vanessa, and let's continue the discussion from the private sector foreign investment. What would be, from your opinion, Vanessa, specifically in Costa Rica or overall in the region, some of the key elements that promote really competitiveness at Costa Rica level, country level, or within the region, in the context of this discussion that we are having on changing the mindset and the approach of the government?
So it was already mentioned, trust. I think it's very important to mention that foreign direct investment follows basically a very basic rule, which is they seek to establish their operations where the host country actually offers stability. And when we talk about stability, it's political, obviously economic, and social. But nowadays, we are seeing more and more companies challenging themselves, not just to find the right location, because they're not necessarily looking for the same things as they did sometime before, like cheap labor. They're actually looking for the right environment to actually strive beyond future. So in that regards, I think, having a right communication with government is very critical. Having the rule of law is actually fundamental. Companies are really hesitant to be challenged for every so often. Rules are changed. The conditions of the country is not clear. They want to take long-term decisions, and in that, as you know, you're experts in this more than I am. It's very important to have a clear vision of where the country intends to go. And part of that is your financial strategy in terms of building, as I said earlier, what will be basically the generator of value that the country offers. In work case particularly, yes, we always promote. In my organization, one of the reasons why Costa Rica is the right location is that stability. But today we are more challenged because it's not the same value proposition of incentive package that are traditional, like tax regimes or things like that. Nowadays, countries will have to be very clever in terms of creating new reasons why. And for that, you have to have your accounting really strong in the sense that you really need to know where your resources are coming from, where they will come from in the future, and how much of that is actually part of sharing the risk of establishing operations that today we are not that sure of the product to actually survive the next wave of change of a generation whatsoever. So I think it's very important to take into account that the balance sheet is strong. The data that is presented there, like any relationship between a partner, each of us need to be on the same side in terms of what we agreed on, what's going to be healthy in the relationship. And companies are seeking more and more for countries to be prepared to walk with them, not necessarily to audit or not necessarily to scrutinize the company from a different perspective, but actually we are seeing the need more and more for countries to actually partner with the private sector and kind of develop the society that we want. I think one underlying case is cybersecurity. I always talk about cybersecurity to be probably one of those areas in which governments and companies are definitely will need to actually work stronger. And the confidence that we have in data and how we manage data from a public and a private perspective is quite challenged. So I think these are things that we need to rethink as countries. Society is changing, and our generations are demanding totally different set of resources, of assets, of goods and services, and probably we don't have the accounting yet for those. So we have to think together how we're going to figure that out.
Thank you very much. That was a very comprehensive and holistic answer. Appreciate that. Let me get back to you, Fergus. And you're coming from New York, and you know how the market reacts to news and to some of the good news and bad news. But right now, I'd like to hear from you, from a due diligence perspective, how the credit rating agencies and the bondholders take into account elements of the different dimensions into consideration from their assessment in the process of assessing government's financial situation or performance.
Okay, so one thing I will say is that they don't take the balance sheet, the entire balance sheet into account. That's a problem. So there's some educating that needs to be done. I do think that the fiscal monitor of last October was a sea change in raising awareness in the overall global financial markets of the importance of looking at the entire balance sheet of the public sector. So I think let's address those in two steps. So the rating agencies, I work for an organization, the Investors Alliance, that meets with rating agencies to try to get them to make fiscal transparency a rating factor. At the moment, they do it by osmosis. They do it in their political environment sections of their methodologies. They do it by looking at one or two indices from the bank and other institutions. But they don't take transparency in and of itself, and they don't use it in their scorecards or their methodologies, and so their ratings are not contingent on changes in fiscal or debt transparency. That's a really important point. Why is it important? Because I think transparency does affect the creditworthiness of a particular country for reasons that we've just discussed. If a finance minister is aware of the liabilities on across the entire balance sheet, then you can manage those liabilities better if you know what your assets are. And so you have a much more holistic approach to public financial management or fiscal policy management. Taking from the perspective of an institutional investor, by which I mean an asset manager, an insurance company, or a pension fund, once again, they're not really paying much attention, and the reason is that they simply don't have the time to dig into the balance sheet. So that presents two problems. One, they need to become educated, which we're all doing with these conventions and events that we have. And the second is to communicate better. For example, Colombia disclosed in its IMF fiscal transparency evaluation last year the disclosure of 3,822 public sector entities. I read that when it came out last August, and I almost fell off my chair. The market was completely oblivious. It completely ignored that point. So I think that there are two problems. One is that the market doesn't fully appreciate the information that it can find in the balance sheet. And then the second is communication from the part of the country and from the part of multilateral institutions and IPSASB and other players who are concerned about and actually see the value in greater transparency.
Great, thank you, Fergus, for being so candid to give us the perspective of the market and where you actually deal and live in New York and around the rest of the world. I wanted to turn back to Alexander because I'm seeing the clock and I want to give some time to the audience to ask some questions. And the question will be, Alex, I know that the Fiscal Monitor was issued in October, and I know that you have mentioned before that you are planning to do some other, including other countries, release the database, etc. But can you tell us or enlighten us, telling us if you have seen any change on behaviors or on the governments that the IMF actually advises since you issued the Fiscal Monitor? Have there been any changes? Have there been anything that you can tell us or that you can perceive that can happen in the next 1 to 3 years after this big report was issued and the IMF got involved, to be honest? The gospel is the gospel.
Okay, yeah, thank you. I think it's a very good question. And in terms of developing these concepts, I think half a year is not a very long time. So it's been half a year since the report is out. But we have seen quite a bit of interest already in the phase that we were developing it. One example is again Indonesia. When the Indonesian authorities became aware that we were developing the entire public sector approach, their finance minister, who is actually ex-World Bank, said, like, why can't my people do that themselves? So basically our answer was, your people can do that and they can probably do a better job at it than we do because you have a lot more information. So she put a small team in charge of doing that, and of course we were in a lot of intensive communication with them. They came up with their own estimates that luckily were fairly close to what we came up from Washington. But they actually see this as a way to improve policy making within Indonesia. So that's one example. I think another example where we have a quite intensive dialogue is with the United Kingdom, where they have developed their balance sheet that took them, to really get a good grasp of all the assets that you have. This is not easy. This is not overnight. I think that took them probably the good part of 5 years to actually get a good set of accounts. And even then, it's not a set of accounts that an auditor would really want to sign off without any qualifications. But they're getting there. But now they're actually undertaking what they call a balance sheet review. So they go very in-depth looking at the assets and say, like, do we need all these assets for the services that we're providing as a government? Maybe not. But then the assets that we do have, can we use them better? Can we use them more efficiently? And again, this is not about selling off your schools and hospitals. But if you have, some hospitals that are basically breaking even, and you have other hospitals that provide very much the same services and they're making losses, you can start to ask yourself, like, is there something that the loss-making hospitals could learn from the hospitals that are breaking even? So there are discussions going on there as well. Now maybe also, you know, within the IMF itself, our country teams are actually using these kind of data more, developing these balance sheets. And this is actually one thing that Chiamara referred to. We will actually be releasing the data, the database that is underlying this work. We'll do that on June 13th with a small workshop, but as of June 13th, this will be on the IMF website. So this is also opening it up to outside practitioners and researchers to do a cross-country comparison. So how does my country compare to others, and how did this evolve over time? So all these data will be available for anyone to use as they see fit from mid-June.
Thank you. That's interesting, and we look forward to the release of that database by end of June. And is that going to be accessible to everybody on the website of the IMF?
Yes.
Okay, something to look forward, in addition to the IMF blogs, for some of you that follow the IMF blog. I'm going to turn back. I'm looking at the clock, and I'm very conscious about the time. So I'm going to have one question for our private sector girls and guys, and just take it, you know, as you can. For Vanessa and for Fergus, I'd like to ask them both, what lessons do you see the public sector actually can draw from private sector in using this approach to attract investments? Vanessa, you want to talk?
So I would think one of those lessons that, at least in Costa Rica, I think we are able to bring to the government, it's the capacity to innovate and to build resilience in terms of facing the challenges of, you know, transformation and change. So change management, actually, it's probably the accurate idea. So we are actually, you know, facing a challenge to continue attracting foreign direct investment, because companies are quite different, the ones that we think we know and that we are able to attract. So we need to have a strong partner in the government that is creative to actually build the right conditions to attract the new type of companies. Even there's the same brand, within them they're changing. So I think resilience and capacity to innovate and to think out of the box will be some of those best practices.
I think I'd respond to that by saying there's huge value in looking at the public sector in any capacity from a balance sheet perspective. In other words, looking at the entire consolidated public sector when you're managing any aspect of fiscal policy or of public finances. And you know, the private sector is required to report under IFRS or GAAP using accrual accounting or double entry bookkeeping and an external auditor. But the public sector simply does whatever it wants. Now, why is that? There is an international standard, the International Public Sector Accounting Standard, or IPSAS. So why are governments allowed to just report whatever they want? So what lessons can a government learn from the private sector? In particular, a government can look at management of the asset side, as we've discussed already. For example, there may be airspace that the government owns. There could be brownfield investments. There could be assets that are lying dormant in an abandoned building owned by the government that is on really expensive seafront property that could be managed effectively apart from the political cycle, the revenues of which can be used for development goals or paying down debt. That is an incredibly powerful argument that most governments in the world completely ignore.
And you take me to the last question specific to John Stanford before I ask each of you to give us a final word, and then I'm going to steal 15 more minutes to wrap up. We started at 4:15, so I'm looking at the clock, so I'm going to be finishing probably 5:45, unfortunately. maybe not. John, following from what Fergus was saying in terms of actually saying that why governments are not required basically to go like the private sector, I wanted interesting to ask you from the IPSAS-B or even your own perspective, it doesn't have to be the IPSAS-B, in your opinion really, how can, in some respect, the full disclosures of financial liabilities by the governments could be enforced in terms of managing and reporting the PPP arrangements, as you mentioned, the provisions for contingent liabilities in general, and pension and employee benefits? Is there any particular recommendation or opinion you have on enforcement of those?
Well, that's not something which is straightforward to answer, because I think sovereign prerogative is very important in the context of financial reporting, and the decision whether to adopt a particular set of accounting standards and which entities within a jurisdiction should report on those accounting standards. Should they be international public sector accounting standards? Should they be IFRS? Should be they some set of local standards? That's something which is going to be made by regulators in the nation state. So it's difficult to bring international pressure to bear on that. Nevertheless, some of what's been said by Alexander, some of what's been said by Vanessa and Fergus, particularly that there's evidence that entities which have a full balance sheet, jurisdictions with a full balance sheet approach, can point to an ability to emerge from recessions more easily. They can point to lower borrowing costs. These are going to become highly persuasive in future years. I should also add that government financial statistics is another dimension to this. So we're looking at two forms of accrual accounting. We're looking at accrual accounting for macroeconomic purposes, governed by the Government Financial Statistics Manual, which is determined by the IMF. And then we're looking at the individual entity level, and that's where IPSAS come into play. And I think it's also important that there's an interlinkage between those two forms of accounting, and sometimes that's quite difficult to grasp. So as far as possible, there is a need for common charts of accounts. So I think we're going to see lots of norms coming into play over the next few years to ensure that information becomes more robust and that the approach that Alexander's highlighted becomes, not just a feature which is here for 1 year, but a feature which is going to become a permanent part of the landscape in public financial management.
Thank you, John. Before we actually give 1 minute to each of our panelists, I want to actually steal from Oscar time, because he's closing, a few more minutes to provide the audience with the time to ask probably 3 questions. And I would like actually to be provocative to you all. So any of you that have a question that really is burning and that cannot be answered by either email or by actually, reading through the IMF blog or some of the IPSAS-B, etc., please go up and stand up and ask the question now, and we will try to get our guest panelists to answer that. I see down there Alfredo. Alfredo, take the mic. And if you can say to whom specifically, if it is to an individual or to all.
Esto es para Alexander.
Parabenizarla pela conferência.
Alexander, state of accrual, which is the balance sheet with a flow, accrual, the gross product for a year, and he does certain comparison, and he says assets, for instance, are 200% more, than the gross product. And these accruals are comparable to understand these in terms of times of gross product over assets. That's the first part. And the second part, if you allow me, Alexander, is the Fiscal Statistics Manual of the Monetary Fund has certain measurement rules which are not the ones we see in public standards, the IPSAS. For instance, in the Fiscal Statistics Manual, we measure inventories at a current cost, while the accounting in Standard 12, we measure at historical cost. In accounting, we have included many updates to reasonable value. In other words, we do updates of value to complete this balance sheet of the public sector, which the Fiscal Statistics Manual does not consider. So I ask you, Alexander, to please comment on the differences of measurement and about the way to relate one flow accrual with a gross product with a balance, which is a...
Gracias. I'm going to take a second question, and then I will pass the mic to Alexander. Someone else? One, going two, going three. So we have two questions for Alex. Alex, the mic is yours.
Okay. Thank you very much for those questions. I think excellent questions. First, I think on your first question, you basically say, okay, a balance sheet, this is a stock variable, assets, liabilities. Why do you scale it by GDP, which is actually a flow? This is purely to get, I mean, we scale everything by GDP to get an idea of how big is this in terms of a country's economy. But I think you're right, and what we actually do, the data that we compile is actually just national currency, billions or trillions. So the GDP is just a scaling factor that I used here. The data that we have is actually just national currency. And what we do there, we have the stocks, and then we have the flows, which is basically your net operating balance plus your valuation changes, your other economic flows. And we do, where we have time series, we do reconcile that. So you will see that your balance sheet stock in year 0 plus your net operating balance plus your other economic flows is going to be your balance sheet stock variable in the next year. So we do have that consistent approach in the database that we actually release in a couple of weeks. You can actually see the numbers. You can see that yourself. But that is very much the underlying concept. Your second question was on some of the ways in which we record and measure things. Now we stick to for very many categories. We stick to whatever governments are currently reporting, and this is basically for reasons of basically capacity reasons. While we had a very large team working on this, it was still not possible for us to redo all these estimates. With maybe one exception where we thought this was very important, and this is natural resources, so natural resources still in the ground, because there we saw that it's important for many countries, but the approach differs a lot across countries. So we basically said, okay, let's take the approach that makes most sense economically. So here we look at not just what do you have in the ground, but what do you have in the ground and you can exploit in an economically viable way. So we look at the price of this commodity at world markets and forward price, but then we look at your cost of exploitation. And if your cost of exploitation is higher than the world market price, basically the economic value of whatever you have in the ground is zero. So we do take this kind of approach, which I think is consistent with, for instance, what you will find in the accounts of Royal Dutch Shell or Exxon. I mean, they also have this economic concept to natural resources. We will actually also, within the next month or two, publish a big, I think 45 page working paper that actually has the methodology and has a compilation guide. So this actually goes into some of the details of these questions. I recommend that paper to you. I was just, flying here this morning. I read through all 50 pages. There is some advantage of getting up at 4 in the morning. You have a lot of time to do things that otherwise you don't get to. So I just read through it, and it's a fascinating read for people like yourselves that are interested in this kind of topic.
Thank you so much, and thanks for the preview. I think with that, I'm going to pass the mic very quickly to Vanessa and also to Fergus and John to give us a final say, and then I'm going to actually close the session so our country manager can come and close after that. So Vanessa, a final word on that.
So first of all, thank you very much to everyone for staying and hanging out with us this afternoon. And I would say that my final comment is norms and standards are even more critical today, but I think we just need to get in agreement that we might need to have more conversation happening between the private and the public sector in order to really strengthen the standards that we expect, or countries and generally their global market to work under. So I think my suggestion would be bringing to the table the private sector actually brings experience. It also brings foresight seen in terms of where where economies are moving towards, and this helps strengthen even more those standards and those norms that rules much of our finance activity.
There are 3 reasons why a government does not disclose all of the assets and all the liabilities on the balance sheet. 1, lack of technical expertise, in which case those governments have access to the World Bank and the IMF and concessional loans. 2, naivety. Many ministers, many prime ministers don't know what they own or what they owe. Therefore, it's in their interest to try to figure out how to identify, value, manage, and then be transparent about the assets and liabilities to the extent possible. 3rd, a government has something to hide. And if a government has something to hide, it means that the policy has a very short-term lifespan. And for that, you can see right through it in 2 seconds. Investors know this and demand a higher premium. Rating agencies know it, and they assign credit ratings that are lower than they would be otherwise. So it is very much in the interest of every government to be as transparent in every way possible. And this includes, by the way, bilateral loans that may not be part of the Paris Club. So I just came from Africa, where a particular government had received a loan from China off the books for $150 million at a rate of 0.5%. 100 million of that was spent on infrastructure projects. The other 50 million, no one knows where it is. So there's a higher premium on that country's bonds as a result. I think that's very short-term thinking and something to be avoided.
Thank you. I'm going to turn now into Spanish to close the session.
John, Alex, Fergus, and Vanessa for their willingness and commitment in making this conference and this closing the success I think we have achieved. This is a very broad topic to debate in 1 hour, 15 minutes, and I took 15 additional minutes. So the only thing I want is to say that we have an open forum. It's not the only opportunity in which we'll discuss these topics. I'm very thankful for their presence, for your patience, and above all, because I think with this session, we have shown that we can work and collaborate together. The World Bank, IMF, Texas, Ipsos B, our investors community or investors representatives, and I include the Inter-American Development Bank, who has been a collaborator in many projects, and to our global partners. We need communication, as Fergus said. We really need to continue working not only in the technical part to improve the knowledge of our institutions, but more than improve the technical part, we need to communicate what's the added value of using an approach for the balance of the public sector the same way we do it in the private sector, even if we have different goals. As we said at noon in discussions with Alex, the private enterprise has a bottom line, has a net income it has to pursue. The public sector is service offering, but if that service offering has a better resource allocation because of a better management of finance, because of better consolidation of how public policies could be directed, we all here have a role to play: accountants, auditors, investors, advisors, and all the multilateral parties. So without further ado, let's give them a round of applause. Thank you very much. And I repeat once again, thank you very much.
Says, what you're saying is very interesting. Now tell me, I want to create a company. Can you help me and teach me how I can develop my books better for me to sell my pigs in the market and not have problems with the banks? And it is at this moment that I realized my accounting professor was fully right. I knew the strategic stuff, but I didn't understand. And I couldn't give an answer on how to develop this person so that she could maintain the development of her company, and in the end she could re-emerge and transform herself into the middle class. Thank goodness we had your team, and we were able to come forward with a plan to do it. But what's the point? What you're doing and what you've been doing these 2 days is not an intellectual exercise for you. It's an exercise that has a direct impact on the development processes and the mission of the World Bank, which is the eradication of poverty and shared prosperity. If in your profession, if it doesn't adapt itself to the new realities, for instance, the internet thing, electronic billing, then as World Bank and as society, we would be wrong in thinking that we can achieve the objective to eradicate poverty. Now, the core issue here is, even if I'm from Argentina and World Bank, can we do it on our own? No. The core issue of what we do as World Bank and what we aspire to doing is creating these partnerships and strategic partnerships, both in the public and private sector and the academia as well. A colleague of mine was telling me, tell them more bridges. And I was thinking to myself, and yes, absolutely. Our role is to be a bridge, but a bridge that takes for these women, these populations that are struggling to creating their companies, can not only create their company and become formalized, but that they can allow for countries like Costa Rica, where there's a social agreement that, as the president of the Association of Accountants, and an agreement that is an example to the world and the region, can keep working and prospering. If we don't work together, if we don't generate this knowledge together, the next time I see this woman in China and she asks me the same question, I won't be able to answer. But I know there's an answer, and the answer exists. And the answer, apart from what you've done in these few days, and starts from what you've done in these 2 days. So I'd like to invite you to drink something so that we can celebrate on this, and that when you do a balance, remember those of us that don't understand accounting. But at the same time, you have to understand and strengthen this tool that is basic for the development process and for the eradication of poverty. Thank you so much. I know it's not on the agenda, but we still have one more plenary to go. No, just kidding. Thank you so much for this extraordinary closing from Oscar. We'd like to invite you to make a toast. Let me congratulate you again, because each one of you has a mission, and for me, it's been a huge honor to have shared these 2 days with you. As a journalist, one always learns, and it's been a blessing to have new tools, not understand a lot about accounting either, but of course, to know more about the mission each one of you has. Good afternoon, and let's celebrate, and don't forget to return your translation devices. Thank you.